Hey, good evening, everyone. This is John Person. Wanted to do a special update for a couple of reasons. Number one, the bond, looking at the knob spread. The newsletter thought we might get a pop, and we wrote the newsletter, thought we would see a pop up and get into the March contract at 18. We do have a small position, an option position on the February expiration puts. We want to add on to that position. Tomorrow's Ben Bernanke's big day with the looking ahead at the fundamentals. The headline news suggests we have a fiscal cliff to deal with, A. B, we have Operation Twist. And then C, we have the fate of the economy. The question is, are the economic reports believable, especially in light of the main focus is creating jobs? And so we've seen the unemployment rate dip from the 9s to the 8s to obviously under 8% now. So the key is, with this last unemployment report, there were no major revisions which took away those big numbers or job increases. So we've had 2 decent months back to back. The question now remains, does Ben Bernanke make a comment that if the fiscal cliff is resolved, then the Fed's main concern is inflation? And if that's the case, all he has to do is mention the Fed's concern on inflation, bonds go down. Why? Because inflation, I think everyone realizes that our taxes are up and probably will go up for those in certain tax brackets. B, cost of living has gone up, except for, of course, housing, but you can't get a loan if you want to buy a house because of regulation and restrictive requirements that banks have right now. So it's a tight lending environment. But I believe that with the Fed's outlook, if they see some resolution to the fiscal cliff, then they may make a comment about their outlook on inflation. And if that's the case, these bonds are headed lower. We're looking at a chart of the knob spread or inverted bonds over notes. So as you can see here, it says US, that means bonds, ZN, that means notes. So that means on the spread chart, bonds are first, notes are second, and therefore we get this line chart. This uptrend highlighted line represents just a swing support line based off of the point that we made on a low on the October 18th and extended it out to the low made on November 23rd. This horizontal line represents an old high that the market broke out on and has been kind of acting as support even as of today's trade action. So even though bonds were down, notes kind of caught up and we saw an uptick, and that's what that line reflects, the bond to note relationship. The notes, same trend line. As we take the look at the low and extend that out, we broke that on today or Tuesday's trade. Bonds broke the trend line, as you can see, to be precise, last week. And that kind of reflects what this knob spread. It shows that the bonds started to outperform to the downside the Treasury notes. If stocks are going to continue to move higher, then we should see the relationship of bonds going down. And if that's the case, the long end of the yield curve is more sensitive to interest rate changes. If the perception is that the Fed's going to do something active to inflation, or if they're concerned with inflation, there's one way to battle inflation: stop printing money, raise interest, and the other is to raise interest rates, which is effectively the same. So maybe we get a clue or a hint as to what the Fed's exit strategy might be to Operation Twist now that we've seen the employment numbers come down. And so these are real concerns that we need to address. Seasonally speaking, the bond market starts to dribble lower right now during this time of the year. So we'll wait till after we get what Ben Bernanke wants to talk about, and then obviously we have to deal with the fiscal cliff issues from Washington. The way the technicals are setting up, if we do break, and many times I've reported that if we do break this support area, and now that we're trading the March contract, the knob spreads change. So I'm looking at, as you can see here, US 2013-03. That means the third month of 2013. Just to give you full disclosure, I am tracking the knob spread in the March futures, and we are tracking each individual issue in the March contract. So both notes and bonds, these are the March futures contracts. So with that said, obviously we had probably set our sights a little bit lower for or higher in the knob spreads case. Instead of looking for a break below 14, we look for a break below this old shelf of resistance, which should act as a new shelf once it's violated. If it's violated, and when it's violated, should act as resistance. So we want to see the market break that support horizontal line, and then it should act as resistance. So that's why I haven't really gotten aggressive with the market, because, or the short side of bonds, because if this even is an M top formation, point A, B, C, we need to break to be more conservative. We need to break this point below, and we want to see confirmation within the knob spread. Another keen observation is, notice that this, in 2 days, the market went up about 3.5 full handles. So if you take a look at these two green bars right here, which was November 7th combined with November 8th, that was the election, of course. So we looked at the money that flowed into, and the pace of change, or the advancement that we see as the candlesticks show these large, tall green candles. Notice on the way down, we haven't even met or exceeded. And typically, when markets go down, they go all at once, and it's very high volume, and everyone capitulates. Notice that even on this little move back, we haven't even taken out that area from the election November 7th. So to me, it's critical to kind of watch not only the price move, but the condition of the price move, and we haven't really seen a full-fledged effort to get people short this market. So to me, I want to wait until after Ben Bernanke speaks and see what the Fed's directives are. All right, so there we have a full-fledged analysis in the bonds, looking at the notes as well as the knob spread. Now let's turn our attention towards S&P. All right, today's action was met with some decent volume to the upside, a nice breakout. Officially, we have broken the neckline of the inverted, as I've been warning everyone, an inverted head and shoulders bottom formation. In time, the distance between the neckline and the head extends out way over 1500 area, and that might take time. So what's the time frame? Usually the distance or the length of the head and shoulders pattern. So it could take from anywhere from 2 to 3 months. And so if this is December, December, if we broke out, so that would be January, February at the very earliest to see that type of a move, which would make sense going into Q1 of 2013. Q1 standing, of course, first quarter. So typically we see the markets break out of the neckline and come back if it's going to be a true head and shoulders, inverted head and shoulders, that the old resistance acts as new support. So that could be, if we get a little further upside, I want to warn everyone, we have resistance here on a weekly pivot at 1440. One of the things that we've never really discussed a lot, and it's now that official, that Mastering the Stock Market's out, and I want to address this issue. I would like everyone to make a concerted effort to buy the book at the same time. I'm going to send an email alert to do that. I really would work on that over this weekend, because I'd like to see people get this book and boost Amazon rankings. A, you do yourself a favor by getting a phenomenal book, and B, you do me a huge favor by getting this in the right hands. So anyway, I just wanted to make mention that the book actually goes into how to address using advanced decline on balanced volume, sectors, seasonal analysis, etc., etc. It's a phenomenal book. I think it's the best work I've ever done, and there's no need to write anything ever in my life again. The Mastering the Stock Market is probably the greatest piece of work I've put together in a no-nonsense fashion. There is some redundancy with the pivots, but one of the things that's not redundant, as I may kind of bring into focus right now, is we now have added quarterly pivots. Quarterly pivots are pretty important, because a lot of times, and I hope no one gets mad at me, especially my community members of Trading Triggers, I've not really alluded to the use of quarterly pivots. I always refer to it as longer term pivots. Well, every time you've heard me say, oh, longer term, I never was referring to monthly. I was referring to quarterly. And what we have done with Genesis is we've added quarterly pivots on this little gray button. We've also added option expiration pivots. So we now have the complete barrage of daily, weekly, monthly, quarterly, and option expiration to the gamut. I don't think that we're going to see a quarterly pivot resistance to 14.99 by the end of December. But certainly if we see, I think we'll probably end the year somewhere around, my guess is we could see the market go above 1450 and probably close the year out right around 1450, more or less, give or take 1.5% is my goal, at least my prognostication. And part of that is based on the advanced decline work. There's just a huge amount of stocks that have moved up in association with this move, and it was on decent volume. In fact, we broke out, if I go over here, the yearly high. If we take a look at some analysis that I'll help you with. If we take a look at the yearly high up here, and on September 14th, we made a high right here. What was the high there? 1468. So move that number down a little bit. And if we take a look at our same time frame, our peak in volume associated with these moves, we just broke out and made a new volume high. So that tells me that there is some buying pressure behind this market, and so therefore we should see a move that might get on not just the inverted head and shoulders bottom, but the quarterly pivots. If we close up in here for the next quarter, it's going to give us a bullish outlook. But back in November, on the 16th, just as we were heading for the Traders Expo, we did hit the quarterly support. And as you notice, we've been in the trading room talking about a lot of stocks gave high close dojis at monthly support right around that same time. So between the 16th to the 20th area, lots of stocks gave us high close doji formations. A lot of sectors look strong. So to me, the technicals are pointing to a resolution of the fiscal cliff. That's what this is sharing with me, and it's not just targeting the E-mini S&Ps, but also the NASDAQ, the Russell, the nice composite. I mean, as you can see here, we didn't quite break out of the neckline on the NASDAQ 100. However, we had looked on the Dow, for example, and we have seen a nice pop on the AD lines, and it's on decent volume. So to me, it looks like a more concerted trade to the upside, and more of a broad-based rally is ensuing. So this will, of course, take time, and there's going to be some bumps along the road. But I think we'll be better off looking at reversals and buying breaks, as long as our AD line and volumes support that market. All right, so for other markets of interest, in coffee, this weekend's video talked about a high close doji in coffee in a seasonally strong period of time. And I said you want to look for a pullback and stops have to go. I said that's a little too much risk for this trader here, especially with what the margin is. And I went through a rendition of about what the difficulty is with trading the commodities this year, is that there's just an enormous amount of capital, intensive capital requirements to hold positions overnight. Gold's $9,000, coffee's like almost $5,000, et cetera, et cetera. So when we say per newsletter unit is $15,000 capital to trade one newsletter unit, I mean, if we do one contract of gold, we're using 60%, more than 65% of our overall capital to trade one small little market. And so that makes it difficult. We switch and alter with option strategies. We switch and alter to which in futures it's been very difficult to get filled, and I don't need to rant about that. Especially with using vertical spreads in gold, it's unfillable. We tried with mini gold corn contracts, missed the trade by a quarter cent, et cetera, et cetera. So in 2013, we're going to do a little switch up here and try to get more markets. Or perhaps we have to sit and think and reflect on whether it takes more money to trade the newsletter, or maybe switch the newsletter around a bit, and we'll alert you to those kind of updated changes. But I can say, looking at the coffee, as it did not take out, I mean, it narrowly just missed taking out the low of that doji there. The market really now needs to kind of prove itself, and for those traders, it seems as if the market's trying to carve out this little bottom here. The volume individual bars aren't really all that helpful, but when we take a look at on-balance volume, we can see that the market, when it goes down, it doesn't do it on significant volume, as the volume bars suggest. So it looks as if it is carving out a bottom. I would say for longer-term trades, when we take a look at the last few weeks, the pace of price change, this may offer you a little bit of help here. The pace of price change, meaning if you take a look at where the close here and where the market's trading right now, there over 1, 2, 3, 4, 5 weeks of trading, there isn't a big price change difference. And when the market gets down near this 140, let's call it 146 level, 145 zone, when the market gets down there, it snaps back up. So there's obviously some buying interest on a weekly basis looking at this chart. The fact that we're not seeing, I mean, the trend, as you can tell, the market closes lower, we make a range, the market trades lower, makes a range, and trades and closes lower. The pace of price change is more dramatic in this developing trend. it is almost as if it's consolidating sideways here with smaller choppiness, but it might be carving out a little bit of a bottom in here. I would say that if you're not in and just want to hold and wait for a weekly bounce, then look for maybe closes on a weekly basis back above both moving average values, and as you can see last week did not do that, or look for more positive gains, buy signals on a daily basis one more time on the indicators. We got one. It was a high close doji. We wanted to look for a pullback, so market pulled back significantly, and that's why I said stops have to go underneath the low of the doji. Stop would not have gotten hit, but man, that was just a lot of risk for a one lot coffee. But there was big rewards too, especially looking for a longer term trade going to seasonal moves. So there is a little light of ray. I just wanted to address this and see what if anyone had questions and concerns on this. Is obviously a concern because it's for a big slinger, it's not a lot of risk, but for clients that are just starting off, the first thing you just don't want to get off and running on a coffee trade. And that's why I didn't make a per se newsletter trade recommendation, because it just doesn't fit within our risk reward parameters, A, and B, it doesn't fit within the margin capital intensive requirement that we are looking for. So with that said, I just wanted to go over that. One of the other trades from a seasonal perspective that we see is copper. Typically it bottoms in middle of December. Well, as you can see, this thing clearly bottomed out in the middle of November, interestingly enough. And so we hit near monthly support, and now we're at monthly resistance in December. So we hit monthly support back in November. Now we're at monthly resistance in December. So if we get a little pullback, and I'd say near maybe monthly pivot somewhere in the next week, 10 days, look for a little retracement somewhere in here, just back to this little rounding bottom. Perhaps this comes into a cup. Well, this would be the cup, and a handle would be the retracement down in here, and that might give you a little guide to the upside. Copper is also one of those high margin intensive trades. Every penny move is $250, so this thing moves from $350 to $360. That's 25. Every dime moves $2,500, so it's a big mover. Or can be. And I think, as you can see, the seasonal trade starts to bottom out right in this time period with its big annual move coming as it starts to carve a bottom. But as we get into the new year, copper sees that big advance, or the main trend occur going in as lasting into April. So we are developing a potential base bottom longer term. If we change this to a weekly chart, you'll see what I'm referring to. Kind of like a double bottom formation. And yes, there is a shot at, if the economy on a global scale does improve, is there room for copper to go to the upside? And the answer is yes. So anyway, these are some of the seasonal trades I'd like to point out. Gold as well. Typically we see gold in the second week of December start, as it shows right here, start to advance to the upside. But with a weekly sell signal, I'd like to see that dissipate. We did get a daily buy, but we're still below the monthly pivot in a bearish outlook. So until things change there, I can't really jump on the gold bandwagon. Crude oil now is, as you can see, on a daily basis. I think you might get a chance for a move to the downside still, giving us a chance. It might put pressure on energy stocks, but good for consumers. But as we head towards the end of the month, we want to be looking for buying opportunities in crude oil going into, it's a little short trend, but the real strong time is not until February that we look for that bottom in crude oil. So again, any short-term rallies in the next, say, week to 10 days might be taken as an opportunity to be selling going into the new year. That's all I have for tonight. I just wanted to give an outlook on the bonds and take a look at where we are with the S&Ps and some of the other markets as they correlate with our overall trading. I hope everyone finds this information useful. And for those people who do have Genesis that have our indicators and our plugins, so I never answered the potential question, how do we get this? This is a special upgrade file that we will give you instructions on how to do. If you currently have my indicators, then this is not going to cost you a penny more. This is my gift, and it is just added, something that we've added to Genesis for our current subscribers. So if you do have our indicators and you have our Persons Pivot package, then you will get this for free, and we'll give you the instructions over the next day or two. So, or you could just bombard us at johnp@nationalfutures.com, and we'll give you the instructions on how to upload that. Hopefully we'll do a video or a presentation, web presentation, that gets you all on board on how to use this exciting, and I mean this is really, I think for everyone's trading, it's exciting to be able to release this to the general public after quite a long time of having it. So anyway, happy holidays, and we'll be back under when market conditions dictate. Thank you, everyone.